Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. For the market, it's still looking quite steady, around 70 points high. We've seen a little bit of a dip come through in the past few minutes, but we are still seeing gains of around 0.4%. But it is the banks where you're seeing a lot of the strength today come through. Let's invite a guest on the show to discuss the market. We have Devang Mehta joining us from Centrum Wealth Management. Devang, good morning and thanks a lot for joining us. So, the key theme that we have been discussing is this entire decoupling of the Indian market from what's going on globally. As much as we've seen sort of some nervousness and all of the fears of recession, inflation play out in the US, our market seems to just be moving higher. What do you expect from here on, and where do you think we can see the market head?
Good morning, Pavitra. Yes, I know that probably everybody is using the word decoupling, which of course I wouldn't like to use at this point. But for sure, I think Indian markets seem to be on a different tangent altogether. And there are, of course, reasons for that. So probably if a little bit of exaggeration is allowed, then it looks like an oasis in the desert or a sort of a silver lining in a global dark clouds. And why I say that? Because at one point of time, just 2 months back, when crude was playing a spoil spot or havoc in terms of having an impact on the Indian economy and even the earnings of a lot of companies. Now with Brent oil coming sub $90, I think a lot of Indian problems get solved. Input cost pressure for a lot of companies get addressed. 38% fall in the crude and trading around say $87, $88. Let's not get carried away. But even for this year, the average crude is around 105 or 100, around 100. And we know that every $10 fall will probably reduce the oil trade deficit by around $15 billion. So one can just calculate how it has an impact on inflation as well as the deficits. So my sense is, one, this is a very important factor which continues to dominate us. Second, despite dollar index continue to strengthen because of the lack of liquidity, a lot of other currencies like the pound or the yen would have touched your 25-year lows. But Indian currency, yes, of course, is also trading near its lows, but it's not been a sort of a havoc. You've seen currency relatively stable than the other parts of the world or other emerging market currencies or even developed market currencies. So I think these 2-3 factors are very important, plus Indian macros, story about the capex going on, $33 billion of outflows and just $7.5 billion leading to markets very close to its near highs. So my sense is the last leg of the rally has been fueled by crude prices, which has come down, a lot of commodities coming down, Indian markets, the Indian economy rather showing a bit of resilience, and also evidences of inflation coming down and a good monsoon as well.
Devang, morning. You started off this conversation by using the word decoupled. The markets may be decoupled in the near term, but India's economy cannot get decoupled from the rest of the world. The interlinkages are too many. So in reality, while the markets may decouple, it's very hard for the economy to be decoupled over the longer term. In that context, given what you're seeing, what are the risks for the market? And are we being a little too overconfident in the kind of resilience the Indian markets are showing right now?
Rima, very, very good question. In fact, yes, complacency shouldn't sort of set in. Such proceedings lead to a lot of people just behaving casually and buying everything and anything under the sun. So that should not be the approach. And as you rightly said, volatility is going to be the order of the day. As we all know that though market might decouple, but economies are linked. In the world of globalization, we can't have a economy which behaves parallelly different than the other economy. So you're absolutely right. Some of the sectors which probably get impacted due to a global slowdown, one needs to just take care of those sectors. As I said, global cyclicals like metals, some of the other companies which are linked. Indian IT is though very competitive. Indian IT benefits from at least a lower rupee. But most importantly, what will happen is whether there are order cuts, whether there are margin cuts, whether the attrition issues come to the fore, or even lateral hiring, does that stop? All these are certain questions which one need to ask for certain sectors. But yes, most of the Indian IT companies, I think, are extremely competitive. So this might be a passing phase. But to answer your question, yes, one must not get carried away by such a rally. And one has to just follow a lot of macros along with a lot of micros.
So Devang, domestically focused themes and sectors, what would be your preference?
Sumera, at the expense of sounding cliche, we have been favoring this one sector, which is sort of building materials or home improvement. And most of the companies in this universe, or most of the sub-sectors in this universe, have seen sort of not only demand coming back. And in India, if I can say, home improvement or building materials is more a consumption sector rather than sort of very deep cyclical. It might have some shallow cyclicality, but a lot of this, as I said, subsectors like paints, adhesives, ceramics, cement, fast-moving electrical goods, all this find favor with investors. Because all these companies are branded. Most of these companies have pricing power, except for cement. Most of the sectors, as I said, have a lot of pricing power, a lot of moat along with the proceedings, high ROEs, and they have good pricing power, which we have seen companies like Asian Paints, Pidilite taking hikes anywhere between 20 to 35%, and stock prices also behaving in sync with that. So my sense is that the building material is one sector which one can't avoid. I was looking at an interview in the morning. Federal Bank CMD on your channel was talking about never seeing such type of credit growth for the first 120-150 days of the fiscal, and all the SMEs and corporates are sort of lining up for brownfield, greenfield projects. All such things prove that a lot of capex is going to probably come into the economy. So BFSI as a sector, capex or capex ancillaries, all these companies, automation companies, would find a lot of favor amongst the investing community for at least the next 2-3 years.
All right, Devang. So we take that point. You like BFSI, you like capital goods, building materials as well. These are some of the sectors that you favor. Thank you very much for joining us today and taking us through all of those ideas. With that, we're going to get into a short break now. But on the other side, a whole host of new releases are lined up in September. This is a whole host of movie releases that we're talking about. We will take stock of the cinema space with Karan Taurani of Elara Securities when we come back.